and I just wanted to say I'm part of the Jay Tolosano team. I'm an extension of his office as the reverse mortgage specialist. Cross Country Mortgage does reverse mortgages in every state, and I'm proud to be on the team called Reverse One. I wanted to tell you a little bit about my involvement in reverse. I started doing them when they were first signed into law in the early 90s as a People's Bank manager. Many of you from the area are familiar with People's Bank and its long history. And they were one of the pioneers in introducing reverse mortgage to the community. Luckily, I've been with Cross Country Mortgage for the last 2+ years. Again, part of Jay's team as well as the Reverse One team. I also spend my free time, believe it or not, as the chair of the Senior and Disabled Tax Relief Committee here in Fairfield. I think it's so important that we always let all mature borrowers know about the benefits, whether it be tax benefits or mortgage benefits. So I do spend my free time making sure everyone's participating in such programs such as tax relief. And again, proud to be a member of that group as well. And I'd like to introduce my coworker, Kelly McCabe. She's also here on video as one of the panelists. She lives in New Jersey, although has lived in many other places in the country, including the Midwest and California. She's our Director of Credit for the Cross Country Mortgage Reverse One division. We are so pleased to have her as one of the leaders of our Reverse One team. She spent over 33 years working with forward and reverse mortgages, and was actually part of the first 50 lenders to roll out reverse mortgage programs back in the 90s. So we'll hear more about her jaded past, I'm sure. She does specialize, Kelly, in risk mitigation and understands the many sides of lending, the lending business, and has coached many loan officers, realtors, title companies, and industry partners, and making sure that contracts are modified and that, you know, everything is good to go so that purchases can be smooth and streamlined. So she's very well respected in the business, and we're really happy to have Kelly aboard today. And if Kelly, you just want to say a couple words to introduce yourself even further.
Sure. Thank you, Cindy, and welcome everybody. I'm very excited to be with Cross Country. I came here just in the new year. Helped bring the division to direct authority, which means we're actually making all the decisions here, which is very critical for us to be successful. And in addition to that, yes, I have HECM for Purchase is my baby. I've been involved with it since it rolled out at the end of 2008. I have a very strong foothold and I'm a subject matter expert for our trade association. And really, the importance of growing this and helping the matured borrower understand that there's other alternatives other than cash buying or forward lending, that this is just another amazing option for them to purchase a new home. So with that, take it back, Cindy.
Sounds good. Okay, today we're going to talk about basically the gray wave opportunity. As you all know, many baby boomers are getting to the point where they are reaching retirement age. And we're here to help them with a HECM, which is another name for the FHA insured reverse mortgage. It stands for Home Equity Conversion Mortgage, also known as H4P when a HECM is used for purchase. We're going to talk about how the reverse for purchase works. And many realtors are on board today, as well as clients and loan officers. So we want to talk about how this benefits all of you and growing your business with a HECM for purchase loan. So I want to, you may see a little bit of a share here. I want to share with you a just an example of how this can work for a particular client. I used a client who was 77 years old, just as you know, he's 62 and above to get this loan. But I want to show you an actual example. And it'll give you a better idea of how this loan can work for your client. Okay, so what I've indicated here on the screen is we have two borrowers here in Fairfield County. And what we do is we use the youngest borrower's age. So again, 77 is this client However, as long as one borrower is 62 or older, we can do the loan. And the other borrower, should they not have attained the age to do a reverse, can still remain on the deed and be a non-borrowing spouse. So we can talk about specifics during or after this meeting today. And if you have specific questions, feel free to chime in. So just to show you a little bit about what we educate the client with and how this can benefit them, I'm going to use the example of you having a client who has maybe sold a larger home here in the area and is looking to right size into the retirement with a home with a value of $400,000. Using the current rates and the age of 77, we are able to grant them a loan, or as you see here, a principal limit of $170,000. After fees are reduced from that amount, we're able to give them a loan, a net loan for about $150,000, which means your client who is selling a home with their net proceeds being at least $250,000, let's say, can bring $250,000 to this closing, get a reverse mortgage for $150,000, and that would cover, all the fees to do with the loan. And that is one way for them to avoid having to pay principal and interest in the future. Again, it's what it's meant to do is to give much flexibility, and financial flexibility is what our mature borrowers are looking for right now. I will tell you this, all the fees can be financed within the loan. However, two items are asked to be paid up front. Everyone who does a reverse mortgage in the country has a phone call or one-on-one face-to-face HUD counseling session. And it's typically over the phone, by the way. That was the one fee that is paid up front by the client, as well as the appraisal once the application is in. So that's just an example of how this particular loan can work for your client. Are there any questions about this particular part of the presentation at this point? Sherry, do you see anything in the chat?
I don't see any questions yet, Cindy.
Okay, I'm going to go back to where we were before. It's going to take me a sec. Let's see here. Here we go. We'll be back at it now. And I wanted to go over just a few things about that particular client that we just showed. The example of the client basically says that they're not going to have to come to the table with having a mortgage, so they're going to have money every month, a little bit extra in their coffers every month. So that's really one of the major benefits, is that there is no principal and interest due, but they will have to pay their property charges, of course. So taxes, insurance, homeowners insurance, and the like. Here you see on the screen just an overview of the program. As I mentioned, the FHA program shows that at least one home buyer needs to be 62 or older. The down payment really is determined by the age, the current rates, and the appraised value. So again, we could work with you on particulars once you have a client that is interested in a reverse. But currently, we're able to loan between 33% and 60% loan to value based on current rate environment. These are only for owner-occupied primary residences. However, what the client does with the funds from the reverse mortgage, whether it be to purchase or in the case of refinancing, which we'll go over later, the money can be used for not just purchasing, but as many of you know, to refinance a current home. And the funds from a reverse mortgage on your current home can be used for any reason. When is a reverse mortgage due and payable? Well, it's when the last borrower permanently leaves the home. So if you have a couple and one of the spouses passes, as long as the other borrower considers this their primary residence, then the loan stays and exists just the way it did when it started. So once both people are permanently out of the home, then that is when a repayment begins. Whether it be somebody out of the home for 1 year because of going into rehab or assisted living, after 1 year, that loan is due and payable. Or if both borrowers, or the case of one borrower, if they pass, their family has between 6 months and up to a year at times to pay off the loan. It's typically 6 months, but 2 90-day extensions can be granted for certain circumstances. One thing I want to tell you about the reverse for purchase or the reverse for refinance. Monthly principal and interest payments are not required, as this is a non-recourse loan and they cannot ask for payment. However, you can make payments, and some people choose to. They get a statement every month and it shows what interest has accrued. And in some cases, my borrowers have decided, you know what, I just want to owe what I started with and I don't want to owe anymore. So this is one method in which they can retain equity in their home. So just so you know that they do not have to make a payment, they just have to keep their property charges up to date, which is the last bullet here on the screen. They must pay their property taxes in a timely manner, as well as any other property charges on the home. And just like any FHA program, keep the home with proper maintenance.
Cindy, we have a question of what is the limit?
Oh, the limit. Excellent question. So we have a limit with the FHA HECM mortgages that we look at values up to $1,089,300 to determine the percentage that we can grant that client. However, we do have portfolio programs with the same investors that go up to $4 million. So we have a jumbo program for clients whose values do go way over the $1,089,300. I will say, because those rates can be a bit higher, sometimes almost 3% higher, we like to first always look at the FHA program because the rate currently has an average rate of about 7%, whereas the proprietary programs are well into the 9s and sometimes even over 10 currently. So we can look at jumbo reverse. They're not called HECMs, they're just called reverse mortgages, and they're from the same very reputable lenders. We are direct lenders, as Kelly said, on the HECM programs, but all the other investors we use when we don't use ourselves have the portfolio programs. Kelly, did you want to talk about that in any regard?
Yeah, I do think if I have some exciting news that I know soon. I can't tell you the exact start date, but I do know that cross country is also working so that we don't have to go outside of cross country, that we will be offering a portfolio as well.
Excellent. So hopefully that answered the question. So again, I have a client right now, one of Jay's clients down by the beach, and the value is just a little over $1 million. And we're looking at the jumbo versus the HECM. However, the HECM seems to give them just a little bit more money because the rate being lower. So we would definitely look at that on a case-by-case basis. But if you have clients with values well over $1.5 million, let's look at the jumbo program for them. So what is the benefit to the real estate agents here listening today? Well, this does increase your kind of pool of people that might be able to take advantage of purchasing power. It allows them to buy more of a home, meaning that, as we mentioned in that earlier scenario, that $400,000 purchase, they were bringing $250,000 to the closing and we were granting them $150,000. That gives them a little bit more money in their pocket. So if they did want to use some of the cash on hand, that's one other way that they can buy, maybe upsize the home that they were thinking about. And working with your builders for 55 and older communities, I know many people here at Jay's team do look at work with builders. And I know that if you're looking with builders that are building 55 and older communities, many times the upgrades ends up being a lot better when a client goes in purchasing with a reverse mortgage, because as we said, they're not paying a principal and interest payment. So they may have a little cash on hand in order to make the upgrades. I think, Kelly, you said there was a higher percentage almost on every senior community.
Yeah, so actually those in the 55 plus communities that utilize the HECM for Purchase program, I believe it's over 75%. Actually, Nick Petrillo had the exact quote that the buyer will actually upgrade more than they thought they could, because they have access to more money through the reverse.
Excellent. And I know there's many of these popping up all over. What are the benefits to your client to get a reverse mortgage? Well, first of all, increases the buying power, as we mentioned earlier, more cash in their pockets to do different things and enjoy their life even more, preserving the savings and investing their assets. And again, this would give you an opportunity to show them a different amount of different homes based on what their financial obligations are, and having really no mortgage payment. Maybe they could look at something in a higher realm. So those are the benefits to your clients. The gray wave opportunity, as I mentioned earlier, is the baby boomers. They are turning, retirement age every day, over 10,000 of them per day. I'm sure we all are familiar with this statistic. And many of you have your designation in working with seniors. And I would really like to be a part of that conversation when you have a client who's looking into purchasing with a reverse mortgage. And I always make myself available to you. So at this point, we're going to take questions if there are any, and then we're going to go on to the second half of the presentation. Anything at all in the chat?
Not right now.
Okay. Sounds good. All right, so we're going to just continue. If anything comes up, please put it in the chat, or we could talk later. So as you all know, with conventional or forward loans, as we call them here, equity is increasing as people make their payments and the loan amount is decreasing. That's a little bit different with the reverse, and I'll get into that next. Again, the borrower owns the home just like they did with the reverse, and any interest paid is tax deductible depending on the tax situation. But let me tell you a little bit about the HECM for purchase. The equity actually decreases because, again, the clients they don't have to make a principal or interest payment. However, although the equity is decreasing and the loan amount is increasing, they do have that control. As we mentioned earlier, it's a non-recourse loan. No payments will be necessary, but payments are always welcome. And there's no prepayment penalty on this loan whatsoever. Go ahead. Someone wants to say something. The borrower does own the home. Their name stays on the deed. It's just like paid off as if any other mortgage was on the home when it comes time to pay it off. And they also are responsible for the payment of taxes, homeowners, or any HOA dues. One thing that many of our customers elect, because they were used to having taxes and insurance paid out of their regular conventional mortgages in the past, is they ask us to voluntarily set up a escrow account for taxes and insurance. So what we do is we calculate what is due through their life expectancy, and we call it a LESA or LESA payment. And what it is, it's an account it's built up in order for us to keep the taxes and insurance in an account so that they are paid like an escrow. There are times as well where we require this account. And that would be if a client has had some issues with credit, possibly more than 2 lates on a mortgage in the last 12 months, or even more than 3 in a 24-month period. Is that right, Kelly? 3 in a 24-month?
So it's actually, they can't have any mortgage lates in the last 12 months, no more than 2 in months 13 through 24.
Okay.
And property charges should be paid without delinquency.
Right. So that's really, this loan has a lot of credibility. Many financial planners will refer to their clients to this program, many CPAs, et cetera, bank personnel, because these loans, as Kelly just mentioned, they're looked at with a financial assessment. They're underwritten. Back in the day when the loans first came out, there may not have been as many controls on these type of loans, but many things have changed over the last decade so that these are underwritten loans. And although we are not FICO score driven, we do look at how they have paid especially their housing payment in the past. And we also look as the tax payment as one of the most important indicators of them paying in the future. So again, if they haven't paid their taxes lately, don't worry. Maybe they haven't paid them in 6 months. If they have enough equity to do this loan, whether it be for purchase or refinance, we may or may not have to set up this account for the escrow, but it doesn't mean we cannot proceed with the loan. Okay, here's just a couple more differences between traditional financing when going to purchase a home versus using a reverse to purchase. Obviously, with a traditional mortgage, there's a lower down payment, and you can do LTVs probably 97.5% in some cases with FHA. Cash buyers obviously can pay in cash and own the home. With a reverse, there is no mandatory payment of principal and interest, as we've said in the past. But the result is that your clients have more liquid assets available. And then why not, might you think, about traditional mortgage? Well, because you're going to have to pay a mortgage payment, right? Whereas with cash, you're tying up a lot of your buyer's money. But with a reverse, because the loan balance does increase over time, and let's say they don't make any voluntary payments, the balance is going to increase. And I just wanted to touch base a little bit on this. Many clients will ask us, what happens when mom or dad or great grandmother owes more than the house is worth? Because that could happen in a market downturn, or if they live a nice, long, and healthy life. Someday they could certainly owe more than the house is valued. And what happens there is there's a protection. Everyone is paid 2% of the appraised value into this MI fund with HUD. So should they someday owe $500,000 and their house is only valued at $450,000, what happens? Well, they nor their heirs will be responsible for the difference, which is wonderful. We've all paid the insurance. We paid it monthly. We paid it as an upfront cost. And there's a protection there so that the heirs are not responsible for the difference, and nor would the owner of the home be if they sold their home and owed more than the house is worth. This is a big question that comes up quite often. Let's say, for example, they wanted to have, after the mom passed, the daughter decided she wanted to buy the home from the estate. What happens is the servicer sends an appraiser out, takes the value there, and the daughter could purchase it from the estate for 95% of the value, and the realtor would, of course, receive their fee. Kelly, did you want to add to that at all, that scenario?
No, I think you did a great job. I think you did a great job.
Cindy,
The most important, the most important piece is it's non-recourse. Both the proprietary product and the HECM product is non-recourse.
Great.
we have a question, Cindy. Can a pre-approval be provided for a purchase using a reverse mortgage?
Yes, definitely. So we're going to get to that, but I'm glad you brought it up. So our pre-approvals are done within 24 to 48 hours. What we get is we use a stated income. We use, and this is again without a contract. If there's a contract, then we do need to go straight to the application. But if it's a pre-approval, all we need is assets, a stated income. We'll get a credit report. We'll get the dates of birth of the borrowers, as well as their identification. We also want to know what other real estate they own. And also, if they are short funds, we will allow gifts, by the way. At the time of application, once their pre-approval was issued, it is good for 60 days and can be renewed once we get the updated documents if needed. Then all we really need to do is order an appraisal, some title work, verify the homeowners is in place, and then verify the income. And Kelly will attest to the fact that we've had closings in under 2 weeks because of pre-approvals being done first.
Right. The pre-approval is most key. We feel the borrower is our best referral source. We also feel that it's very important their experience be top-notch. When you pre-approve them, you really settled all of any type of credit that we have to look at and the assets to close, which are the two key components to the loan. Once they're pre-approved, you're really, when they're ready to apply, we order title, we order an appraisal, we make sure an HOI policy is going to be in place for 1 year. And then at that point is when they actually verify the income documents that they stated they're going to use to qualify for the residual income calculations. So it's a very smooth process. It's very thorough. It's quick. And we always at Cross Country like to be the first to the closing tables. That's very important to us because it lets our borrowers know that we have a handle on what we're doing. So it's a great process. It's been very successful. Our competitors use it. We created the product a few years back when the purchase rolled out at a different company, and it just grew throughout the industry. So it's very successful.
And Kelly, you mentioned residual income, which brings up a great point. The way we qualify our borrowers for a reverse mortgage or HECM is we take their gross income and what we're doing is we're looking for residual income. And here in Fairfield County, the residual income for a single borrower is $540, and for a couple is $906. So we'll take their grossed up not grossed up, but we'll take their gross Social Security before Medicare comes out. We'll take their pension, any rental income, any income at all, subtract out all of their installment, revolving, and their property charges. And as long as a single borrower has $540 at the end of that transaction, we'll be able to do the loan, or a couple having $906. Now that's, again, for purchase and also for using the HECM to refinance, meaning I own my property, either I have a small mortgage or it's free and clear, and I want to get money out. And that's called a traditional HECM or HECM refinance. So what we're doing is we're taking equity out of the home. So let's walk away from purchase for just a second. And if we talk about that, and let's say the client is looking to refinance their existing property with a HECM, and they might be short residual income. What we do is we actually take their assets and we dissipate them, just like we would do on a purchase. We would dissipate them as income. But also when refinancing, we're going to use that credit line that we're going to be granting them, and we're going to dissipate that over their lifetime. And that too is a form of income, which is going to most times help them qualify much easier. So I know that was a lot because I know you don't see these every day, but I just wanted you to know that both for purchase and for using the HECM on your existing property. Because as realtors, the realtors that are on the call, maybe your clients aren't looking to purchase right now. Some of those clients, they're in a home, you got them a beautiful home and they want to stay there. But how are they staying there with the taxes going up and their income staying the same? Always introduce your current database and client base to the reverse, which is called the traditional HECM refinance. And I'd be happy to get into that more in detail with you on a one-on-one, or if we have time after the call.
One other question, Cindy, I'm not sure if you want to address now or later. Is it better to have only one of the two in a couple on the loan?
Okay, well, if it is a couple that are both living there, married, then they both do have to be on the loan. However, so you can't just pick and choose, like who's going to be on it, who's not. It's only when somebody has not attained the age of 62 or older that they cannot be a borrower. However, they would still be a non-borrowing spouse that would be required to do the counseling and would sign affidavits at the closing showing that they understand that a reverse mortgage is on their primary residence, and that they understand that in that case, should the spouse who had attained the age of 62 or older pass, that loan is due and payable because they were not a borrower. But if both people are on it.
Cindy, I'm going to jump in on that one.
Sure.
If you don't mind.
No
when
problem.
There is a non-borrowing spouse and they are married, they actually have what's called the deferral right. And as long as they're identified at time of application as the married spouse, they can remain in the home until they pass. What happens is you have a borrower, let's say the borrower is 67 and the spouse is 60. So they're not HECM eligible yet. They would be identified as the non-borrowing spouse. They have a deferral right to stay in the home till they pass. The only difference is if their borrower, their spouse passed, the money, if there was any kind of distribution set up, a 10-year payment, or if there's a line of credit that the spouse was drawing on, that money would freeze. But the non-borrowing spouse can remain in the home until they pass, as long as they continue to pay the taxes and insurance and maintain the home. So it does not just become due and payable with the non-borrowing spouse.
But as you said, Kelly, if they had any like kind of monthly stream of income or anything like that, it
That would
cease to
stop
exist.
because they were not the borrower.
And what about if they had an escrow set up?
Meaning a non-borrowing household member.
Let's say that the borrower passed and the non-borrowing spouse wanted to stay in the home, but they needed that escrow account that we provided them, the LESA account. Is that also frozen?
Yes, the LESA account would be frozen. All funds are frozen when the borrowers pass. All funds are frozen, correct?
Right.
They would have to go on and maintain. That's why the non-borrowing spouse is counseled. They're coached to, there is deferral rights to stay in the home. However you set up in a purchase transaction, typically it's all funds are in, you purchase the home, and we do encourage, our loans have a line of credit. And I know Cindy's going to get to that when she talks about the refinance loan. But the line of credit is a really key component, and we do also encourage them on our purchases. They only have to be set up with $50 at time of closing, and then at some point in time, a borrower can put some of their asset cash into this line of credit, and it grows. This is one of the best features of the HECM. It grows at the note rate. So like Cindy mentioned, that you may be getting a 7% purchase. A borrower may have sold their departing home, and let's say they had $50,000 equity extra when they sold their departing home. They held on to that money, but opened up a line of credit when they purchased the home with the HECM for purchase. 6 months into the settlement of owning that home, they decided to take $10,000 of that 50 and put it on our line of credit that's growing. That grows at the note rate. So imagine today, where are you putting $10,000 in cash and getting interest growing at the rate of 7%? So another great feature of the HECM for purchase.
Excellent. Thank you for the clarification.
And the HECM traditional.
Let me ask you this. If they get a proprietary account, a proprietary loan, is that also a non-borrowing spouse able to be on those loans as well? And is there protection or not?
Yeah, so the non-borrowing spouse on the proprietary does not have the deferral protections that the HECM does. So you want to be aware of that. A lot of times in the proprietary product, the investor will require the non-borrowing spouse to meet with a lawyer, and some of them videotape it because they want to make sure there's an end game in case the spouse were to pass away, and that they have an understanding that they will need to refinance and this debt will need to be paid off. So on proprietary, it's a little less protective, but on the HECM, it's 100% protective. They can stay in the home for the rest of their life until they pass.
Right. That's a great point. And that's really what this loan makes it very, very different, I believe, in the sales of this loan, is we're really trying to protect the homeowner, the borrower, every way we can. I personally, and I know my team of salespeople, we want to make sure that our clients have involved their realtor, their attorney, their CPA, their trusted financial advisors, maybe their best friend. Maybe it's the guy that rakes their leaves, but we want to make sure that someone other than the borrower is involved in the process. I know working with people well into their 90s and almost 100 or more, many times their best friend is that person next door, and that becomes their power of attorney in many cases. I want you to know that we work with power of attorneys, conservators, guardians. We not guardians, no, there's no children, but we basically make sure that everything is in place and that the customer understands what they're getting into. That's why the client's HUD counseling is vitally important and required. And another thing is, I, again, personally always ask, who are the people in your family that should know what you're doing? And whether you want to tell them or not is up to you, but let's make sure that the people that you want to know about this transaction are kind of in on it, and they could listen in on the counseling if the client would like that. They can be there every step of the way. And we actually require an alternate contact. So when somebody's applying for a reverse mortgage, whether it be purchase or refinance, it's a requirement that we ask for an alternate contact. Should we someday not be able to, or the servicer not be able to find the borrower? You know, maybe they didn't respond to a postcard that said, hey, is this still your primary residence? Because once a year on the anniversary of the loan, they're going to receive a letter or postcard asking if this is still their primary residence. And if they don't hear back from the client in a timely manner, they may send out a reminder. But after that, then they're going to need to call this alternative contact. That could be a friend, a neighbor, your attorney. It could be anyone you choose. So Sherry, we're good with questions right now? Okay, we'll just go on. I didn't hear her. She fell off. So who's eligible? What kind of properties for the HECM purchase? Single or really the refi as well. Anything 1 to 4 families, 1 to 4 units, just like FHA is for any other loan. Manufactured homes that meet criteria. I know that a CO has to be obtained. Maybe Kelly, if you could just confirm that a CO, 90% of the build must be done before we can take an application on these homes.
Yeah, so we have one definition of property, which is existing. Those of you who work with builders, we typically appraise the property at 90% complete. Not like a forward FHA loan. Our 90% complete pretty much is you're just missing trim and appliances. We can appraise at that point. We can process. We can get the loan ready for closing. We must have a final certificate of occupancy on the purchase loans at or before closing. In the traditional world, let's say you want to do a refinance and you just recently occupied a newly built home. So if the home has been constructed on a refinance in less than 12 months, we just evidence that you had a CO prior to the application date. And we have ways of getting an equivalent. We work with all 50 states, and Washington, D.C. is the 51st state. And we have ways of getting that equivalent as well. So you do need a certificate of occupancy prior to closing on a HECM for purchase, newly constructed. And on a traditional refinance, if the home has not been occupied or you just recently occupied a newly built home, there has to be a CO prior to application.
Excellent. And then of course, FHA approved condos are always an option, and PUDs, all of them. If your condo is not FHA approved, we do have a system to smoothly get the single unit approval or full complex approval if that is an option as well. So don't give up if it's not FHA approved. We do have ways to get a single unit approval. What properties are not eligible? Investments, vacation homes, B&Bs. But of course, if you have a home now and you have enough equity, you could certainly get a refinance reverse and purchase any of these out of pocket. Again, we have no restrictions on what the money is used for when using a reverse mortgage. So here's a couple things, what you should know. Lenders, we can take applications for new construction loans, as Kelly mentioned, just prior to the receipt of the CO with the 90% finished work. Seller concessions are not allowed from any interested party on the HECM for purchase. However, any that are normal and customary seller fees are allowed. We would just need something stating that these are common and customary in the area. And I know realtors, you come across different fees that are allowed depending on your market. Credits are not allowed, nor can the client borrow funds required for closing. They can't borrow funds, but they can get a gift with the intent not to be paid back. Now, Kelly, answer me this. Can the gift be the entire down payment?
Actually, it can. One of my favorite reverse stories that we did, we had an elderly couple. The wife, her husband had just passed away, and believe it or not, she was 90. She had never made payments on any of the bills because she had her husband and he took care of all of their finances. And unfortunately, the stress of the passing of her spouse, she let her homeowner's insurance lapse. And this is a true story, and it really is a remarkable power of the HECM for purchase. She lived in a home that was approximately $200,000, and there was a fire, tragically. The home burnt down. Her 4 children each gifted her $50,000, so a total of $200,000, and she was able to buy a new home, brand new, in a 55-plus community with all the bells and whistles. She did spend $300,000, and it was beautiful. But the entire down payment and closing costs were funded through her children as a gift, and each of them came forward for her. And it was really a great, powerful story of how, one, how family comes together, but 2, how this really helped her in such a stressful time. So yes, it can be 100% a gift as long as it's verified correctly.
Excellent. Okay, so I think everything that Kelly said and I said right now is, I mean, we do want to spend a little time on the realtors and maybe writing up the contract. So I'm going to take any other questions first, but then I want to show you a job aid that we've created just especially for realtors to assist you in writing up the documents that you need to get this contract written. Again, you're going to be choosing the title company. So you're going to have you're choosing the title company. We will assist them, and Kelly could attest to this. Right off the bat, we are going to be there for your title company and educate and make sure that they understand how the HECM for purchase contract works. It's not that much difference, but there are major differences that have to be a part of it. So what I'm going to do is we're going to make this document available to everyone on the call. It'll go out with the recording. But it's basically, how to write up the HECM for purchase contract. And, our most important mission is to make this as painless for all of you, the borrower, you, the realtor, and the loan officer that referred you to me to get this done. You have us in your corner. We're going to help you from start to finish. I have to say, I have clients I'm still in touch with that I closed loans in the early 2000s. Many that know me can attest to the fact that these clients become our family. Many times they don't have a big family to rely on or an advocate. You, the realtor, you, the loan officer, have become that advocate, and we do continue that spirit. And our most important mission is serving you and your client. And of course, as part of Jay's team and a part of the Reverse One team, you can always count on me, Cindy. I'll be here on the 46 Miller Street if you need me, or come to your office. Or to your client's home. I have eaten a lot of cookies and many cakes and tea over the years, and I'm very proud of that. I have probably tried every kind of muffin that any senior has ever tried to make. But the fact is that we sit at their kitchen table, we sit at their dining room table, we meet their whole family. Sometimes we'll have a call. I had a trust, because again, I wanted to bring this up when Kelly mentioned gifts, and families. Trust, whether irrevocable or revocable, are allowed on reverse loans, purchase and refinance. We do need to take a look at them, review them, make sure that the borrower is the beneficiary. And we do have an attorney that will look at all of them as well as a second check. We do, again, work with POAs, conservators. And if somebody can't get a POA because they have already started dementia or Alzheimer's or Parkinson's, we will work with them and you to get them the right attorney or the proper paperwork from the town official to get things done. We close on conservatorships and POAs daily. We're not afraid of anything, as Kelly said. We are the first and foremost company, cross-country mortgage, and we plan to be #1 in purchases. And Kelly will probably echo that. So let me give her 30 seconds for that, for certain.
Yeah, so I think what's critical, and Cindy is your partner, is that especially with this writing a contract document, it's a great job aid for you to, again, make this experience the right experience for the borrower. Because for us, our borrower is the best referral source. We're not subject to TRID. We do still work with a HUD-1. We are available to train any title company, because you may say this is an FHA loan. In their minds, they think forward. They don't typically do a reverse. So we want to just let them know we don't work with loan to value terminology. We work with what's called a max claim. We work with a principal limit. We want them to understand how to, we want to make sure they still have access to HUD, one, and two, we want to make sure that they understand how we disperse. We do disperse and fund purchases on the same day in all 50 states. We do sign and disperse on the same day. And we really coordinate with the departure homes or the homes that they're selling, because about 85% of our transactions are really simply a transaction of selling a home, all the net proceeds moving to settlement, which is very easy. And then we close on our purchase. So Cindy's your person, and I'm always here to back up Cindy whenever she needs it. So back to you, Cindy.
Thank you, Kelly. All right, so at this point, if you have any questions, please let us know. You could, I'm not sure, Sherry, if they have to unmute, or you can see something in the chat.
Currently, there are no questions in the Q&A.
Okay, so then we've totally blown everyone away with our presentation, and they just are a loss of words. I get it. I know that this is a lot, especially if this is new subject matter to you. Some of you may come across somebody in the next few days or the next week, now that we've talked about reverse to purchase. Please know through Jay or myself. We'll make sure you have my contact information if you're on this call. Again, I want to be there for you, your clients, their families. So certainly whatever we can do to make the education of the benefits of a reverse mortgage, whether it be for purchase or for refinance. I know we didn't spend a whole lot of time on the refinance, but just so you know, the actual percentage that we give on a purchase is the exact same percentage that we will provide on a refinance of an existing home. So I know here in Fairfield, working on senior tax relief, many of my clients have bought their ranch homes by the beach for $20,000 in the 50s, and now they're worth $800,000 and above. And they are looking for ways to pay their taxes, to pay their bills, to make sure that they have all the proper medication and groceries they need in their home to survive. So look into your database to see if we could possibly help your clients refinancing their current existing home. And even if they've had credit issues in the past that we talked about, maybe some mortgage lates recently or some tax lates, that does not mean they're out of the ball game. We have pulled people out of pre-foreclosure in order to get these loans done for them. I find that the reverse mortgage program is really case by case, person by person, and every situation is different. The cross-country mortgage team they have a committee, and Kelly's on it, that looks for ways to make the loan work no matter what. So please know that we're here for you. I don't want to take up too much time if you don't need to be on the call, because it's 20 after 1, although we have allotted 10 more minutes. I'm happy to stay on for other questions.
One second.
Sure.
We want to know about refinance, which I think you just answered. And then what is the percentage for refinance?
Okay, it's going to be anywhere from about a third. So a 62-year-old may only be able to access about a third currently, whereas up to age 90, you're talking about closer to 60% and above. So, and that really is based on the current rate environment. Because the rates are higher right now, as you all know, and the average rate somebody getting a reverse mortgage today is paying or not paying, but interest is accruing at 7 on average. It's basically, or it's really over 8%. So plan on around just about 8%. And because of the rate being where it is right now, the loan to values are affected. So certainly 18 months ago, this might have been closer to 50% for a 62-year-old. And when and if rates go down again, the loan to values will change. It is going to be strictly based on their age, the current rate environment, and the value. So right now it's 33 to about 60% LTV. I know it doesn't seem like a whole lot, but again, when someone's purchasing, in many cases, they've sold another home. And because of course they're 62, so they're probably already a homeowner, 62 or above. and they will have proceeds from the sale to put down. So sometimes, you know, if an 81-year-old can get 50%, it doesn't seem like a whole lot, but many times, again, they're selling another home and their proceeds are plentiful to put down the other 50%. So LTVs will change, but we'll certainly be able to do a proposal for any client at any time. But currently, again, a third to about 2/3 is what's going to be the loan to value.
Okay. That is all we have for questions.
Okay, it was wonderful to talk with you, and Kelly and I, again, are part of the team of Reverse One, and we are happy to answer any questions you have in the future. You'll have my contact, you'll have this job aid, as well as the recording to refer back to. But please know that a scenario can easily be put into a proposal. That proposal will include a lot of background information about the reverse. There's no obligation for your client to move ahead just because they have a proposal. But just so you know, we make these proposals available the same day. So as soon as your client needs to know what they qualify for, with, again, a name, date of birth of all the borrowers, we can put something together same day or next day at the latest. So looking forward to working with you in the future, and please drop me a line once you have my contact information. I look forward to it. And thank you, Kelly, for coming aboard.
Absolutely. Always happy to be here for you, and great job, Cindy. It's a great program, and it's definitely a lot of information. I always say take 5 minutes afterwards and kind of think about all the things she's brought to the table. And then you'll realize when you start looking at your data source of potential buyers, past buyers, et cetera, and so forth, you'll find that there's a great need for this program. So everybody have a great day. Thank you.
All right, take care. Have a great afternoon. Bye-bye.